All right, so we're going to use this as an example, try to tie some of these terms that we just talked about into a problem. So we have a company, Merrick, and Merrick is the one who is selling. So they are factoring to a factor. I know it's kind of weird that the verb to the noun, right? But they are selling receivables, Merrick is. And they factor or sell $40,000 of their receivables. That's the book value of receivables in the AR account of Merrick. So they sell them to KLP without recourse. We'll talk about recourse in a second. As we mentioned, the factor is paying less than 100%. So they advance cash in the amount of 90% of the book value of the receivables. And let's look at that really quick before we go any further. 90%. So how do those two pieces fall out in the journal entry? We credit the receivables to show the removal of ownership or transfer of ownership. It is a sale. And Merrick no longer has rights to these receivables as part of the sale. We only get 90% of the receivables sold. So 90% times 40,000 that we sold comes to us in cash. Now, why didn't we get the full amount? Remember, the factor is going to hold back $10,000 and it's a cushion for the factor because they're trying to collect receivables. Those could end up as returns, discounts, or sales returns and allowances. So they do not give the full 40,000. And even if they collected all 40,000, they still want to keep 2% of cash as a fee to conduct the transaction. Remember, in effect, Merrick is borrowing money by selling receivables. And this 2% is a sort of interest. Even if all $40,000 of receivables are claimed, Merrick's not going to get $40,000. So that factor fee ensures that there's a little bit of interest earned by the factor, and it's 2% of the receivables that they withhold. So let's talk about those withheld receivables. They withheld 10%. So 10% times 40,000 gives me the $4,000 not advanced by the factor. But we're not going to record a $4,000 receivable because I, as the seller, know I'm not going to get some of that money back. There will be some sales allowances, returns, and discounts. And so some of that $4,000 is not going to come back to me due to the risky nature of a receivable not being paid. And the 3,000 or basically in order to give credence to that idea, the seller is going to assess the fair value of the withheld receivables. So they think they're going to get 3,500 back after sales returns, allowances, and discounts. So this is the fair value assigned by the seller. So we could maybe record that, except remember, the factor takes its fee from the receivables it withholds. So it's withholding that 10%, 2% of the full amount of receivables sold is the fee that the factor's charging. And that fee is $800. We are definitely not getting this part of our withheld receivables back. So there's a gap of $500, and this is what we don't think we're going to get back, right? Establishes the fair value of the amount that was withheld. And then there's the 800 we certainly know we're not going to get back. And so that leaves only $2,700 to record as the receivable from the factor. Now this says due from KLP. KLP is the factor. It's the same account really. Receivable from factor, due from factor. They're two different names for the same item being recorded as transaction. They're both assets. The cash, of course, is an asset, and we're giving up receivables. So that's a credit to an asset and reducing my assets. So the 2,700 we got, remember, it's a two-step process. We'd start at the amount that was not advanced by the factor, the $4,000. We then assess what we think we're going to get back after the factor collects and reduces it by all the things it couldn't get because of discounts, sales returns, and allowances. That's 3,500. Then typically the factor fee is taken out of this. This is that guaranteed amount we're not going to get back. 3,500 minus 800, 2,700. That's the amount we record. Now, the loss on sale could just be the plug, right? We basically debit this cash, debit the receivable from factor, we credit the accounts receivable, and then whatever we need to get the journal entry to balance. But I want to give you another way to think about it other than just a mechanical plug. What the loss represents is the difference between what I get in a transaction or what I got and what I gave up. So think about the things that we got. We got cash of 36,000. So we had an increase in assets from $36,000 cash. We also had an increase in assets because of that receivable that we recorded that we believe we're going to get back from the factor. And what did I give up? So I gave up those receivables. The receivables of my customers. So then I just combine it. Well, in total here, I got $38,000 of assets. And over here, to get that $38,700 of assets, I had to give up $4,000 of assets. The loss is the difference between what I got and what I gave up. The 1,300 between the two. Essentially it's saying, look, you only put this many or this number dollar value of amount of assets on our balance sheet, but you took off 40. And so because assets overall declined from 40 down to 38.7 from this transaction, we have to record a loss, a reduction to equity. Remember, this does reduce net income. And I will also catalog that up here. All right, so let's look at what happens when the transaction wraps up. Let's say that the factor was able to collect all the receivables except they weren't able to get $1,000 from sales returns and $500 from sales discounts that were taken. Remember, this receivable from factor is what is the cushion that is used. So we only expected $2,700 after the factor fee was taken. We're getting rid of this receivable from the factor because the deal is done. All of the receivables are collected. So we're settling the receivable at the end of the factoring transaction. But we're not going to get cash for the entire receivable because some of it was used. Right, so there was some sales returns, some sales discounts. Both of those items reduced net income for the seller because they had recorded revenue on the receivables initially before they sold them. And this cash is just what's left over, right? We had $2,700 we expected in our receivable from the factor, but $1,000 ended up in sales returns. And $500 were taken as sales discounts. So after that has been taken out, we received this much. So this is $1,200 cash from the originally withheld receivables. Remember, all of this came from the company originally withholding $4,000 of the $40,000 cash payment from the receivables. So now let's talk about recourse. Recourse is essentially the same thing. Oh, real quick. Of course, cash is an asset, and the due from KLP, since it's a receivable, we're crediting it. We're reducing assets with that. So the recourse obligation attached to this deal doesn't really change much. The kind of too long didn't read synopsis is the recourse has to be recorded as a liability. This is the liability that the seller has incumbent upon them in case any of the receivables that were sold end in bankruptcy, and therefore the factor can't collect them. So it's a different risk than sales returns, allowances, and discounts. This is covering the risk of bankruptcy, basically bad debt, risk of bankruptcy of receivables, customers. So the factor would be forced to take and eat that loss in a without recourse option. But with recourse, the factor no longer has that risk. And because the recourse liability protects against that risk of bankruptcy, it tends to lower factor fees for these transactions, right? The factor is protecting itself with this recourse liability. If some of the receivables it buys go bankrupt, they still receive cash from the seller. So they don't necessarily have to charge as a high risk factor fee for this transaction. We do record the amount assessed as the recourse liability. This is still assessed by the seller. They have an idea of how much of the receivables they sell may end up in bankruptcy and unable to be collected, just like a bad debt if they had kept them themselves. So they know that number and they can assess this recourse liability. And the amount they assess is just added to the overall loss on the transaction. So remember, the loss on transaction without recourse came from two places, really. It came from the seller's assignment of fair value to the receivables withheld, the cash that was not paid by the factor. The cash that wasn't paid by the factor was 4,000, but we decided, hey, they're really only worth 3.5 after returns allowances. And that was a $500 reduction in value. And then was the factor fee of 800. Those two gave me the loss in the original scenario. Now we're going to add the recourse obligation too. So the overall loss then becomes three things: the reduction to fair value of receivables, the recourse liability that we just added, and the factor fee. So let's look at the same players in a different example. And we'll talk about the loss when we record it down here. So same information as before, but all we're doing now is adding the factor, I'm sorry, the recourse obligation to this piece. The seller guarantees the payment if the customer doesn't pay. So basically, this is the statement assessing recourse. So the seller covers bad debt expense, which means recourse. So it's still a sale of receivables, but we just estimate that 4% of the receivables factored are going to be our recourse obligation, our recourse liability. Remember, this is assessed by the seller. 40,000 times 4%. So we as the seller are saying we think of these 40,000, 1,600 may be uncollectible because of bankruptcy and an inability to make payment on their accounts. Everything else remains the same. The receivable from KLP is the same because all the other facts remain the same. So the recourse doesn't affect the receivable from KLP, doesn't affect the amount of cash that was advanced, the receivable sold. We do tack this on as a liability, $1,600. And that is added directly to the loss from before. Remember, the loss from before was the 1,300. That consisted of the factor fee of 2% and the reduction of fair value of the receivable from KLP by the seller. Now we're just adding the 1,600, and that gives me the 2,900 altogether. You can also, again, think of this just as the plug, because after we record the cash, the receivable from KLP, the recourse obligation, and the reduction of our accounts receivable, the only piece left is the loss. It'll plug to get debits to equal credits and make the journal entry balance. But again, let's think about what I got and what I gave up. And there's a little bit of a twist this time because I still gave up $40,000 of receivables. That has not changed. So my assets still go down $40,000 due to the credit to receivable. Right? We still get $36,000 of cash. So that's an asset. We still receive the 2.7 thousand receivable from the factor. So this would indicate what we saw before without recourse. The $1.3 thousand differential between these two added together and 40,000. But we also got one more thing. Now we also have a liability. And as you might imagine, even though we were happy about our asset accounts going up, we're not so pleased with the fact that now we have a $1.6 thousand liability, right? Essentially, when we compare the two, we'll now think about not just the assets that we got, but also the fact that there was a liability as well. So when I consider both of these together, I got $38,700 of assets, but that $1,600 liability as well. And when we consider net assets, the net value, I had 37,000.1 net assets. That's what I truly got when I subtract off that liability. This doesn't change at all, of course. This is a $40,000 decrease in my assets, but you'll notice that the $2.9 thousand loss comes from evaluating the difference between the net assets that I got versus the net assets I gave up. Now, again, let's just go to the end of the arrangement and see what happens when we have to settle out. So assume this time that there were no discounts or returns. This would then give us back the receivable from KLP fully in cash because of the no sales discounts or returns. That's the protection that the receivable offers the factor. But if there was no protection needed, the factor will return all the money. Remember, the recourse obligation deals with bad debts. So there was $1,000 of accounts that were determined to be uncollectible. The bad debt of our seller that sold bad receivables to the factor, they have to actually provide cash for that because of the recourse obligation. So the recourse obligation forces the seller to pay this cash. That's the credit to cash. The recourse obligation is settled out. $1,600 is what we assumed we would have to cover because we didn't have to cover the full 1,600. We only covered 1,000. This is a reversal of the unpaid liability. I didn't have to pay all 1,600, only had to pay 1,000. So I get to recognize a small gain when I don't have to pay the rest of that. Why am I recognizing a gain You're thinking, well, okay, yeah, that wasn't you avoided a bad situation, but why a gain necessarily? Well, remember, when I recorded this recourse obligation, it reduced my net income as a loss. It added to the overall loss that I recognized on the sell. So I had anticipated $1,600 of a loss in my net income when the sell happened. After we did some fact checking, right? The reality sets in. We didn't have to use all 1,600. We actually only used 1,000. Well, then 1,600 was too much of a loss to recognize. So we reverse 600 of it with a gain. Right? I'm going to do one more example in the next video, and then we will work a lot more of these problems in some future pieces.